Welcome to The Explainer. Today, we're diving into one of the most wild financial mysteries of the whole AI hardware boom. We're zeroing in on Supermicro. They're a massive player in building advanced AI servers. Now, on the surface, this AI gold rush, it looks like a literal license to print money for the companies building the hardware. But a recent, absolutely massive $7 billion equity financing package by Supermicro, well, it just ripped the Band-Aid off a deep, structural strain on corporate balance sheets. We're going to decode exactly what this capital crunch actually means, and not just for Supermicro, but for the entire rollout of corporate AI infrastructure.
All right, let's jump right into Section 1, the $39 billion paradox, booming orders versus collapsing stock. So, Supermicro recently locked down an almost unbelievable order pipeline. We're talking roughly $39 billion in AI server orders from over 20 major corporate customers. Now, by any traditional metric, a backlog that huge is a massive win, right? But here's where we hit our central mystery. Why on earth did a stock sitting on $39 billion in incoming orders crash 27% in a single day? I mean, how does a company sitting on a literal goldmine of demand suffer such a sudden, brutal market collapse? It completely defies common sense. More orders should equal higher stock prices. But to figure this out, we've got to look past the top-line revenue and dig into the actual nitty-gritty mechanics of building AI infrastructure. Which brings us to Section 2, the AI cash flow crunch, the hidden cost of building the future.
Okay, so the root cause of that massive stock drop actually comes down to a harsh reality of the AI boom. The raw materials are just astonishingly expensive. On one hand, you have this incredible $39 billion in orders, but balancing that out is a totally brutal operational toll, $6.8 billion in negative free cash flow. You see, Supermicro can't just magically assemble these servers out of thin air. They have to go out and buy highly specialized, incredibly scarce components. We're talking premium GPUs from companies like NVIDIA, plus all those super complex liquid cooling parts. And here's the kicker. All of that has to be paid for before the final servers are ever delivered and the revenue actually comes in. Negative $6.8 billion. Just let that sink in for a second. Over a recent 12-month period, the immense cost of buying all this advanced tech inventory just completely swallowed the company's internal cash. To put it into perspective, Supermicro's yearly operational cash flow was hovering around, well, $1.5 billion. That is literally a drop in the bucket when you're trying to bridge a $6.8 billion gap. The demand for their AI infrastructure just completely outstripped their ability to pay for the raw materials out of their own pocket. Basically, Supermicro hit a severe capital crunch. In plain terms, that's a situation where business just flat out lacks the liquid cash it needs to keep operations running and actually buy its inventory. Because winning the orders, that's really only half the battle. If you don't have the massive upfront capital to actually buy the parts to build those liquid-cooled server racks, well, those orders mean absolutely nothing. They needed cash, and they needed it yesterday. Moving on to Section 3, the $7 billion dilution, how to fix a cash bottleneck. So, faced with this massive bottleneck, the corporate management team had a really tough choice. They could either take on crippling high-interest debt, or they could pivot. They chose equity. It played out in a rapid four-step process. First, they get the $39 billion in orders. Second, the executives realize, we have a $6.8 billion negative cash flow drain. Third, the board steps in and approves a massive $7 billion mixed equity capital raise. And finally, they actually execute the public sale, knowing full well the market was probably going to react pretty harshly. To actually source that mountain of cash, the $7 billion raise was sliced up three ways. The biggest chunk was $3.75 billion in depository shares, which were linked to mandatory convertible preferred stock. Next up was a $2 billion at-the-market program that basically allows them to just trickle new shares directly into the open market over time. And finally, $1.25 billion in standard common stock. The whole goal of this structure is to convert investor capital directly into manufacturing inventory, basically sending the funds straight out the door to suppliers like NVIDIA. But there's a really heavy cost to this strategy, and that is equity dilution. By pumping millions of new shares into the market, the company is decreasing the ownership percentage of existing shareholders. They didn't magically increase the fundamental value of the business. They just sliced the ownership pie into way smaller pieces so they could generate the cash to build the servers. So to get the cash they desperately needed, Supermicro essentially had to sacrifice existing shareholder value. And that leads us to Section 4,
The market freak out. Panic and pivot.
When this financing package officially launched, man, the stock took a massive 27% nosedive in a single day. That sudden influx of new shares triggered a severe sell-off, and it wiped out billions of dollars in market capitalization almost instantly. Investors were hit with a double whammy of panic. First, panic over that immediate equity dilution, and second, panic over what this actually meant for the company's shrinking profit margins. If building these servers was genuinely this cash-intensive, that's a huge red flag.
The capital pivoted practically overnight. While Supermicro was plummeting 27%, one of their major competitors, Dell Technologies, actually saw its stock rise by 4% on that exact same day. It created this incredibly stark division in the tech sector. Investors actively yanked their money away from Supermicro and parked it with competitors that they perceived to have way more stable balance sheets. Basically, competitors who might not need to aggressively dilute their stock just to fund their AI server builds.
So what exactly fueled this specific panic? Well, there were four main things. First, the ongoing dilution effects from that $2 billion at-the-market program we talked about. Second, non-binding order risks. Supermicro explicitly warned the SEC that those $39 billion in orders, they're uncommitted. That means enterprise buyers can just cancel or delay them. Third is fierce margin pressure. The intense competition out there makes it super hard to just pass those soaring chip costs onto customers. And finally, corporate governance baggage. Supermicro has been dealing with lingering investor distrust because of past accounting challenges, external legal probes, and even the resignation of its previous auditor. All of that just makes investors hypersensitive to any volatility. All right, let's look at the big picture in Section 5, Warning Signs for AI, the Macroeconomic Reality. Let's zoom out for a second. What does this one single capital crunch actually tell us about the broader tech economy? Because the practical implications here are rippling across the entire industry. If you're a hardware executive, the lesson is crystal clear. Prepare for capital constraints. Just winning orders isn't enough anymore. You absolutely must have a bulletproof balance sheet to fund the raw materials. Now, if you're an enterprise buyer, expect intense scrutiny from your boards. They're going to demand rock-solid proof of return on investment before greenlighting these high-cost data center purchases. And for you investors out there, it's time to shift your metrics. We have to stop evaluating companies purely on their growth narratives and order pipelines and really start analyzing free cash flow and margin pressures. And that brings us to a really critical macroeconomic warning. If hardware companies cannot pass these soaring component costs onto their final customers, profit margins across the entire tech sector are going to contract. I mean, think about it. If the cost of NVIDIA chips in liquid cooling systems stays sky high and brutal competition prevents server builders from raising their prices to match, well, the profitability of the entire AI hardware sector is structurally capped. There's just no way around it. Which leads us directly to this really powerful summary from our source material. Quote, "The event warns of a business cycle correction, signaling a high-risk landscape for long-term tech spending." End quote. The broader market is finally waking up to the reality that corporate AI growth requires incredibly massive upfront cash outlays. This is a highly capital-intensive transition, and the financial foundation underneath it all might actually be a lot more fragile than the initial hype led us to believe. So I want to leave you with this final, provocative thought. When you look at the massive cash strains, the heavy equity dilution needed just to stay afloat, and the intense, crushing pressure on profit margins we've explored today, is the corporate AI boom heading for a hard landing? As the initial excitement of this gold rush meets the cold, hard reality of corporate balance sheets, the answer to that question is probably going to define the tech economy for the next decade. Thank you so much for joining me for this explainer today. Keep analyzing, keep questioning, and I'll see you next time.